My name is Breanne Riley. I'm here tonight to share my Capstone project with you guys on the effects of COVID-19 and key events and their effects on trade regulations. So unlike everyone else who has background in some type of business administration or some type of analytics, I have no experience. Before starting this program, and currently I work in strictly law and finance. So it was a little hard to try to figure out what type of data I should collect and how to collect it. So thankfully, throughout this whole semester and throughout other semesters, I was able to understand different types of analytics to determine what I wanted to study. So, is it coming? So of course, this is the breakdown of what I'll be discussing tonight. No need to go through it. In the ever-changing business terrain, companies must adapt to the supply chain changes and shifting marketing demands, especially the era of efficient supply chains and international trade. The recent surge in international trade regulations intensified by the challenges of the pandemic, and it disrupted the supply chain, impacting the trade deficit on the United States. Today, I will present an analysis over the years of 1992 to 2022, comparing two deficits that we experienced during the 2008 global financial crisis and the 2020 or 2019 COVID-19 pandemic. I wanted to start off by showing you guys a slide that I found by a group of economists, and they revealed a decline in the U.S. export growth from 2018 to mid and late 2019. It's important that we continue to study the effects that trade regulations has on the supply chain and what it can do for us moving forward. Trade regulation impact is challenging to quantify due to lack of hard numbers. However, utilizing data from the U.S. Bureau of Economic Analysis, I tried to bridge the gap and analyze trades over several years and decades. So it was kind of hard because I had so much data. So I formed two sets of hypotheses. The first set is focus on the overall impact of imports and exports. So the first hypothesis is when U.S. international trade declines, it significantly affects imports more than exports. And then hypothesis 1B is when U.S. international trade declines, it significantly affects exports more than imports. While the second set looks at specific service categories that especially trade industry sees a big increase rather than a smaller increase. So there were numerous studies that I found about trade regulations. One of them that stood out for me was one conducted by Anderson and Van Wenkoop in 2003, where they came up with the gravity model, or they studied more on the gravity model. So the gravity model represents the amount of goods of locations, typically measured by their gross domestic product and the distance between those locations. So in smaller words, it just says how much stuff can get traded in between two places depends on how big their economy is and how close or how far apart they are from each other. People who use this model often tweak the formula by adding certain criteria like the size of the population, how similar the cultures are, or even the political relationships between the countries. This helps make the formula more predictable in trading in different situations. Another report that I really enjoyed was from the U.S. Bureau of Economic Analysis in July. Like we learned in Dr. Scala's class about moving average, here you can see that this article used a moving average to determine the deficits in trades and goods amongst 3 months in the year of 3 months in different years of 2023. So like moving average, we know you sum up the subject month and the 2 prior months, dividing by 3, showing the average at the end of the month of the periods. It even out the bumpy parts of the data, so it's easier to see trends as we see here with the 3-month average. So I gathered my data from the U.S. Bureau of Analysis covering the period of 1992 to 2022, which is about 30 years, specifically during the 2008 financial crisis and the COVID-19 pandemic. One of the major issues during the pandemic was dealing with the importing of goods and services between countries because everything was shut down. So I tossed out all the incomplete data and focused on the past 30 years. And I made sure the data wasn't playing any tricks on me, so I adjusted it by seasons. This evens out the ups and downs in the supply chains that happen regularly. Instead of dividing it by monthly details, I tried to keep it simple and just do the bigger picture, which were usually totals. This made it a little less overwhelming because if you think about all the trades of goods and services between every industry, every country, it's a lot of data. So I tried to just limit it to two things that we knew that happened, that something big was, and which was the 2008 financial crisis and the pandemic. So to test my hypothesis, I used descriptive analytics examining the U.S. international trade of goods and services. As you can see down, it's kind of blurry, but in figure 1 and figure 2, nothing really jumped out to me with the goods and services here and goods and services here. All we know is that when the U.S. has a positive balance of goods of service, they have a negative balance of goods. But if we can take a closer look here, you can see in figure 3 and 4, which is exports and imports. I'll go back in between. It's hard to put them on the same slide to explain my data. When we look at the numbers here, we can see the two major slowdowns in the data, which are at 2008 and 2009 during the financial crisis, and then again in 2019 and 2020 for the COVID pandemic. So what does that say about the data? To even get further, I can say that, I'm sorry, the slides are moving. I don't know why. You can see that the slowdowns occurred at two major points, which we know, the COVID-19 and 2008 global crisis. Looking at the trend line, they pretty much match, but the drops in goods here in imports are bigger than the drops here in exports. To quantify what I noticed, I use a formula that describes the difference between two percentages. When we look at the numbers, it shows the imported goods had a big 26.2% drop during the first dip in 2008 and 2009, while exported goods had a drop of only 18.2%. That's a big difference, which is over 30%. While there is no noticeable difference in 2008 and 2009 dip overall, there isn't a significant difference in the trade deficits between imports and exports. So I rejected both alternative hypotheses from the first data set. Therefore, while it is surprising, I failed to reject no hypotheses. When the United States international trade is down, there's no major difference between the trade deficits in imports and exports. So I went a little deeper. There were a lot of categories for the industries. I did about 11 of them. Maintenance repair services is really small, so I'll just read it out. Maintenance repair services, transport, travel, construction, insurance services, financial services, charges for the use of intellectual properties, telecommunication, other business services, personal culture and recreational services, government and goods and services. My findings here support the notation that during the U.S. international trade, the goods and services of travel has taken the biggest dip, and I'll show in the next picture here. So you see on both exports and imports, green is travel, and that was my second data set of hypotheses that had the biggest dip in the financial sector from 2008. You can see right here, and then again in 2020, which was the pandemic in 2020. So as expected, both imports and exports show similar trades, very graphs that we can reject both the null hypothesis and the second hypothesis data set. But all of this goes to reason that there may be an industry specific tariffs brought about in these specific terms, meaning something may have happened during these times which affected the trade of imports and exports, which we know everything was shut down during 2019, 2020 pandemic. So I took my time to look at how trade rules affect the U.S. international trade. I used an approach due to lack of numbers on regulations. We can't really pinpoint when the regulations happen and where it relates to. I focused on U.S. imports and exports to simplify the analysis since there was so much data. And I examined data from the US Bureau of Census and the US Bureau of Economic Analysis. So my first data hypothesis, I began with the data plots. There was really no difference which I anticipated, but there was a positive balances in services and a negative balance in goods. Then I broke it down individually and uncovered some significant drops in both exports and imports during the global economic turndowns, especially during 2008 and the pandemic in 2020. I then went as far as going to compare 11 major categories to prove that during the 2008 and the 2020 pandemic, that the travel industry suffered significantly, which supported my hypotheses. So consequently, both of the null hypotheses and the second alternative hypotheses were rejected, indicating potential industry-specific tariffs impacted service categories like travel. Some recommendations for additional research would be to undertake in-depth analysis of tariffs in the trade regulation sector. It's hard to pinpoint when certain crises are going to happen. So now that we have one, which is sad we do, there is more data out there that we can research. It's just so much data in so much different industries because all of our stuff is imported and exported between countries. One thing I did want to throw out there that I learned in my first semester here was when we're buying and you're sourcing and stuff like that, that was affected major because most of the stuff that gets sourced has to come from out of the country. And so when industries are shut down and borders are shut down, it affects the supply chain greatly. You can't have the supply chain rolling without the supply. So in conclusion, this study explores how trade rules impact U.S. international trade over 30 years from 1992 to 2022. Surprisingly, I didn't find a big difference in the trade deficit between imports and exports when international trade is down. But when you do break it down into categories, travel is one of the major categories that is affected during any type of trade that's declining or there's a deficit. As the world changes, this research highlights the importance of improving how we study the relationship between trade rules and the supply chain. I do want to first thank my advisor, Dr. Feng. It was really hard for me to figure out which approach to go for my project, and she really helped me out and took her time. After every question I asked, was just probably every week. The only reason why I even knew about the supply chain program was Ricardo Griggs, who's my mentor at Northrop Grumman. I wish he could have helped me more on the project, but he is so busy with Northrop Grumman. So it was a little hard, but I do thank him because if he could tell me about supply chain, I would have never joined the program. I do want to thank all the professors at the Towson supply chain program. Everyone worked with me so well. It was a new industry for me. Everything was new. I met a lot of great students, and I do appreciate everyone for always helping me out when I needed it. And Dr. Staler, thank you. Here are my references.
For Breanne.